Joining us now is Dean Maki. He's the chief economist at Point72 Asset Management. CNBC senior economics reporter Steve Liesman is here with me as well. Dean, I'll start with you. And Steve made an interesting point earlier. You almost think there'd be a bigger market reaction to how strong the data was this morning. We're talking kind of in the sense of, how many more Fed cuts to really expect here.
Yeah, well, I mean, it really was strong data with the 0.7 rise in core retail sales. And it's looking, again, like we're going to have a 3% growth quarter on real GDP in the third quarter. We had that in the second quarter, and we've averaged that over the past year. So there's kind of a theme emerging there. Consumers are spending. That looks like a 3.5% growth quarter for consumer spending at least. So it is very strong data.
Does the Fed need to be cutting at all in this kind of environment?
I think the economy would grow fine if the Fed was not cutting. The Fed is trying to reduce any potential risks by cutting at this point and trying to get closer to a neutral pace. But if the Fed wasn't cutting, I would not be concerned myself about the growth outlook.
So are we saying that the neutral rate is 4.8%?
I don't know what the long-term neutral rate is, which is really what the Fed is thinking about. Several years out, what would be the neutral rate? But I do think what we're seeing is that growth has been 3% with the Fed funds rate at 5.25 to 5.5. So in the short term, anyway, the economy is able to grow with rates at that level.
Yeah, Steve, it's remarkable. I mean, who would have thought we would have been here?
I think that there are reasons to cut, and I'm interested in what Dean thinks about this. There are people out in the economy that are paying very onerous interest rates right now. You look at a recent survey I saw, small businesses paying interest rates above 10%.
Yeah.
Home credit cards, those sorts of things. There are reasons. And I worry a little bit, just because the marathon runner is still doing his or her, 6 or 7 minute mile in a marathon? Maybe it's 5 minutes these days.
For the pros, maybe less.
With 100 pounds on the back and it's found a way to get by. Doesn't mean it's the optimal amount of weight this marathon runner should be carrying.
The only thing, though, and I take your point, is if for some reason it is the optimal thing to be doing right now, and you start cutting and stocks are at record highs and services inflation starts looking a little sticky, do you have a problem on your hands?
I think you do, but I think, and again, I mentioned Dean's point of this, what I think Fed Chair Powell and the Fed has told us to focus on, whether or not it's right, I don't know, is that GDP in and of itself and the labor market in and of itself are not the sources of inflation. That we have still some of these supply side things to work through and other issues that are out there, and that he is less concerned about either GDP or jobs as the source of inflation. Definitely the labor side, and maybe less so the GDP side. I think that the U.S. economy is dynamic, finds a way to get by, but that doesn't mean we're at the optimal amount of weight it should be carrying.
Dean, what would you say?
I mean, I don't object to a gradual interest rate cutting program by the Fed. I would get very worried if the Fed were to keep moving at quickly down to what they perceive as neutral. But if they're going 25 per meeting and observing the data, I don't think the risks are that high. I think the main risk is just that we don't get inflation down. Inflation right now is 2.7% on the core PCE. It could just get stuck in that 2.5 to 2.75% range. It's not a disaster, but it isn't what the Fed's trying to achieve.
Did you hear the gentleman from BlackRock on this morning who said that, and these guys stand astride the housing market. They say their housing increases are 2%. And we have inflation in the CPI at 5%.
For housing inflation.
So that's going to come down. And by the way, people ask me, why is Europe doing better than the U.S. on inflation? Well, one reason is they don't include housing in their inflation numbers. So they use this thing, which we talked about, the Harmonized Index of Consumer Prices, the HICP.
As the ECB keeps cutting.
Right. And I think, Dean, I haven't looked in a little bit, but we're kind of in line with them on that. So the ECB's cut twice, and we have a Fed wondering why it ought to cut again.
Yeah, I mean, it gets into kind of a philosophical argument about whether we should have housing costs in there. I think the Fed would have a real problem on their hands if they were to strip out housing costs from inflation. So I do think they're supposed to be in there, and it's a reasonable way that we define them. And the Fed has defined their inflation target to include those costs. So I think that's where we're at, and the Fed will monitor them.
Dean, I hate this phrase, but I think it's a good one. The data is not a suicide pact in the sense that just because it's in there doesn't mean we can't look through it and say, you know what? Of course, you want to be consistent. I think that's what you're saying, Dean. But in the idea that if it's in there and we have other data showing, better data showing it's down.
Of course.
Doesn't mean we shouldn't make policy.
What is the super core showing these days?
The super core was north of 3. I have to look it up again.
Dean, are we still north of 3 on super core?
Yeah, I would hesitate to not to include the housing in there because, once we start stripping out this and that, it gets into a pretty dangerous game where, the Fed says inflation is low except for the stuff that's not low. So my view would be we do need to have those housing costs in there.